Good morning and welcome to the Post-Monetary Policy Committee press briefing. This briefing, as is usual, is held after the Monetary Policy Committee of the Central Bank of Kenya holds its meeting. It held its meeting yesterday, which was Tuesday, the 8th of October 2024. And today, Wednesday, the 9th of October 2024, the governor, who's also the chairman of the Monetary Policy Committee, will be briefing us with regard to the thinking behind the decision, and we'll also be able to take your questions. Please send your questions via Slido. That's www.slido.com. The meeting is hashtag MPC 1024. And please make sure you include your name and your institution and keep it brief so that you're able to accommodate as much as possible. But for now, I'd like to introduce and welcome the Governor of the Central Bank of Kenya and also the Chairman of the Monetary Policy Committee, Dr. Kamau Thugge.
Thank you, Wallace. Good morning, everyone. During its meeting on October 8th, 2024, the Monetary Policy Committee lowered the central bank rate, the CBR, from 12.75% to 12%. The MPC noted that overall inflation has declined further and is expected to remain below the midpoint of the target range in the near term, supported by stable food inflation attributed to improved supply from the ongoing harvests, a stable exchange rate, and lower fuel inflation. The MPC also noted that non-food, non-fuel inflation has moderated and is expected to remain stable, and the central banks in the major economies have continued to lower interest rates in response to easing inflationary pressures, with expectations of further reductions in the coming months. The MPC also noted the sharp deceleration in credit to the private sector and the slowdown in growth in the second quarter of 2024, and concluded that there was scope for a further easing of monetary policy stance to support economic activity while ensuring exchange rate stability. The MPC will closely monitor the impact of this policy measure as well as developments in the global and domestic economy and stands ready to take further action as necessary in line with its mandate. The committee will meet again in December of 2024. Some brief highlights of global economic developments and outlook. The global inflation has continued to moderate, mainly supported by lower commodity prices and the lagged effects of previous monetary policy tightening. Central banks in major economies, including the US Federal Reserve, the European Central Bank, the Bank of England, and also the Bank of Canada, have lowered interest rates with expectations of further reductions in the remainder of 2024. Global growth continues to recover in 2024, supported by strong growth in the US and India, as well as improved growth prospects in the United Kingdom. Risks to the global growth outlook relate to elevated geopolitical risks, particularly the conflict in the Middle East. Global financial conditions have also eased, with expectations of further declines in policy interest rates in advanced economies. Bond yields have declined, while the performance of equity markets has improved. Kenya's real GDP growth is expected to remain above the global, the sub-Saharan Africa, and emerging market and developing economies averages in both 2024 and 2025. With regard to the global headline inflation, this has continued to moderate, mainly driven by lower commodity prices and the lagged effects of previous monetary policy tightening. The headline inflation rates in the major economies have continued to ease, and as you can see there, on the left-hand side, we have the U.S. inflation. We have data up to August. And you can see that inflation as of end August was 2.5. I believe the inflation for September should be coming out anytime soon. But clearly there is a downward trend for inflation in the US. There is similarly a downward trend in the inflation for the UK and definitely for the Eurozone, which we have data for up through September 2024. And as you can see, that inflation is now below the 2% target at 1.8%. Nonetheless, core inflation has remained sticky, mainly driven by services and wage price inflation. And overall, the global inflation is expected to decline from 6.7% in 2023 to 5.9% in 2024, partly due to the cooling labor markets in the US. China's inflation has remained low due to weak domestic consumer demand. With regard to international oil prices, these have moderated, but the risk from the Middle East conflict remains elevated following the recent escalation of tensions. Oil prices have declined, mainly reflecting increased supply from non-OPEC oil producers, but also weaker demand in China. Going forward, the OPEC Plus meeting that was supposed to meet in September did not take place. And this meeting was to unwind the production cuts that had been made before. And that unwinding was to have begun in October, but that has now been delayed to December. And this should further stabilize fuel prices. The main risk to oil prices, again, relate to the potential supply disruptions as a result of escalation of the conflict in the Middle East, and also the expectation of increased oil demand following the recent easing of U.S. monetary policy and potentially the increased demand for oil as economies begin to expand from the loosening or the easing of monetary policy. With regard to global food inflation, there was a slight increase in September 2024. Now, global inflation was at the food inflation was at 2.1% through September, and this largely reflected the increase in edible oils price inflation, which increased to 17.8%, and this more than offset the deflation in cereals price inflation, which was minus 10.2%, and also the sugar price inflation, which was also negative at 22.7%. Turning to the global economic activity, we see the growth continues to recover, supported by strong growth in the United States and some of the emerging markets, in particular India, but also there's some improved growth prospects in the UK. Looking at the last 3 quarters in the US, we see the US has sustained a fairly strong performance. The second quarter of this year, the US economy grew by 3.1% compared to 2.9% in the first quarter. And similarly, the UK showed some strong recovery. The first quarter was, they grew by 0.3%, and in the second quarter accelerated to 0.9%. We still see some, the recovery in the Eurozone continues to be quite modest and lower than expected. And you can see largely reflecting performance in the German economy, which in the second quarter contracted by 0.1%. India's growth continues to be fairly strong at 6.7% in the second quarter. China's is 4.7%, but this 4.7% was slightly lower than had been anticipated. So looking at the year as a whole, we see global growth remains at 3.2% projection for 2024. This is from the July 2024 WIO outlook. We suspect that the new projections or the new WIO for the annual meetings later on in this month, that will have new projections on economic growth globally. But based on the July WIO projections, the world growth was to remain broadly unchanged at 3.2% in 2024 from 3.3% the previous year. And also the projection for 2025 was again just around 3.3%. And although there was a downward revision in the US growth from 2.7 to 2.6, we anticipate that that growth will be revised upward in the October WIO projections, based on the fact that the first two quarters in the US were fairly strong, and also based on the fact that data from last week in the labor market in the US suggests that the US economy has continued to grow strongly in the third quarter. The United Kingdom growth is expected to be at 0.7%. This is much improved from the 0.1% last year. And again, we expect that to accelerate further to 1.5% in 2025. The Eurozone growth was 0.5% last year. The WIO projection is for a growth of 0.9% in 2024, and a further acceleration to 1.5%, largely as the German economy continues to recover. In the case of China, the growth remains relatively strong at 5% this year compared to 5.2% last year, but has been projected to slow down somewhat to 4.5%. India's growth continues to be very robust at 7% this year compared to 8.2% last year, but also to continue to register a strong growth of 6.5% in 2025. Lastly, again, these are WIO projections. Kenya's growth is projected at 5% this year and also 5% in 2025. But this growth for Kenya is well above, as I said earlier, the global growth average, which is 3.2%. And it's also higher than the average for the emerging market and developing economies, which was 4.3% this year and also 4.3% next year. And it's certainly higher than the average for sub-Saharan Africa, which is 3.7% this year and 4.1% next year. The global financial market conditions have improved, and this is reflected in better performance of the equity markets. And this improvement reflects in part the increased market expectation of further policy interest rate cuts in advanced economies. The improved financial conditions have also resulted in lower Eurobond yields, and this has eased market access for emerging markets and developing economies, as well as emerging economies such as ours. If you look at the slide on the right side, shows the Kenya's Eurobond yields as of September 30th, 2024. And you can see that in the last 1 month, there's been a significant improvement and reduction in the yields on all the Eurobonds that we hold. Turning to the domestic economy, just a summary of developments on inflation. The inflation has declined in September 2024 and remains below the midpoint of our target range. The overall inflation declined to 3.6% in September 2024 from 4.4% in August. Food inflation declined, mainly reflecting a decline in vegetables inflation. Fuel inflation eased mainly on account of lower electricity prices and also pump prices. The non-food, non-fuel inflation moderated on account of the lagged effects of monetary policy tightening, and the appreciation of the exchange rate has also reduced imported inflation. The inflation rate is expected to remain below the midpoint of the target range in the near term, supported by a stable exchange rate. Food inflation is expected to remain relatively stable on account of improved supply attributed to ongoing harvests. Fuel inflation is expected to remain low, mostly due to base effects. And finally, the non-food, non-fuel inflation is expected to remain low and stable. So the overall inflation declined in September 2024 from about 4.4% to 3.6%. And this decline was driven by lower fuel, food, and also the non-food, non-fuel inflation. In terms of the contribution to overall inflation, again looking at September 2024 when inflation was 3.6, most of that inflation is accounted for by food, which is 2 percentage points, and followed by the non-food, non-fuel, which is contributes about 0.9 percentage points, and then fuel, which contributes to the overall food overall inflation by 0.7. But you can see between August and September, basically there has been a reduction in all percentage points. The non-food, non-fuel inflation contribution has declined from 1 percentage point to 0.9 percentage points, and the big reduction has been fuel, which has declined from 1.3 to 0.7, and a minor reduction in food contribution from 2.1 to 2 percentage points. With regard to the non-food, non-fuel inflation, as I indicated, it has declined in September from 3.5 to 3.4%, but essentially it has this inflation has remained broadly stable all the way from around November 2023, when it was 3.3%. It rose to a maximum of 3.6 within this time period, but has since trended down and is now at 3.4%. In regard to food inflation, this declined in September 2024 from 5.3 to 5.1, and this reflected the easing of vegetable price inflation and low non-vegetable price inflation. As you can see there, the contribution in terms of percentage points of the food inflation of 5.1, 4.5 came from vegetable inflation, and only 0.5 came from non-vegetable inflation. Looking at the vegetable inflation, we can see that it peaked around July at 33.3%, and the reason for that increase to 33.3% reflected the excessive rains and floods that were experienced in April and May, which disrupted supply of key vegetables, particularly onions, tomatoes, as well as cabbages. The prices of this key vegetable, particularly again of onions, tomatoes, and cabbages, have eased due to improved supply following increased domestic production. And as a result, the vegetable inflation has decelerated from 33.3% to 28% in August and further to 22.1% in September. Respondents in the September 2024 agricultural sector survey expect food prices to decline in October 2024, but some upward pressure is expected on some select vegetable items due to seasonal factors. Turning to the non-vegetable inflation, the food inflation for non-vegetables has moderated the overall inflation, and as you can see, the non-vegetable inflation, the decline peaked in July, where there was a minus. Inflation was actually negative in July. It's still negative in August and still also negative in September. And this negative inflation has been having a moderating effect on both the food inflation but also the overall inflation. Sugar prices have also been declining. As of September 2024, sugar prices had declined by almost 30%, and this reflected the improved supply due to favorable weather conditions. The contribution of sugar prices to overall inflation was minus 0.4 percentage points in August and also September 2024, and this was down from positive 0.5 percentage points in January. And globally, sugar prices have moderated with improved supply. With regard to fuel inflation, this declined in September 2024 quite significantly, and this was driven mainly by lower electricity and also pump prices. The September 2024 agricultural sector survey shows that most respondents expect inflation to decline or to remain unchanged in the next 3 months. And specifically, in the case of September, the 54% of the respondents expect inflation to either decline or to remain unchanged, and only 46% expect inflation within the next 3 months to increase. Turning to the domestic economic growth, real GDP growth slowed down to 4.6% in 2024, in the second quarter of 2024. This was compared to 5.6% in the second quarter of 2023. And this deceleration was reflected in most sectors of the economy, and in particular construction and mining and quarrying sectors recorded negative growth or contractions in value addition. The growth prospects for 2024 have been revised downward to 5.1% from our previous projection of 5.4%, and this revision reflected the growth outcome for the second quarter of 2024, which shows a slowdown in growth. It also reflects the slowdown in private sector credit growth to several key sectors. However, 5.1 still remains quite resilient, and that resilience reflects strong performance of key services sectors. The robust performance in agriculture continues to perform well, and improved exports are expected to continue to support growth going forward. Growth will also be supported by enhanced trade initiatives, including the African Continental Free Trade Area, the agreement with the European Union under the Economic Partnership Arrangement, and also the tripartite agreement signed in July of this year between COMESA, the EAC, and SADC, and also bilateral trade arrangements which are expected to boost exports. The main risk to the growth outlook relates to the worsening geopolitical environment. In terms of the real GDP growth for 2024, as I indicated, has been revised down to 5.1%. We now expect agriculture to grow by 5.3%. This has been revised downward from what we had before. We had 6%. The industrial sector continues to be fairly a drag on the on economic performance. We see it is expected to grow by 1.1%. We still see some contraction in the mining and quarrying for the year as a whole. Manufacturing had picked up in the second quarter this year to 3.2%. This was better than we had expected, and therefore we have revised manufacturing upward slightly from the 2.3 to 2.7 for the year as a whole. Construction, the value addition in construction was negative in the second quarter, which was a huge reduction compared to other quarters, and therefore we expect for the year as a whole for construction value addition to remain relatively unchanged compared to the previous year of 2024. The services sector still remains quite robust. In the second quarter, we saw a deceleration of the services sector to 5.5%. This is still fairly strong, and for the year as a whole, we do expect services sector to remain relatively strong and to grow at 6.2%, supported by wholesale and retail trade, accommodation and food services, which is expected to grow quite strongly at 26.6%. But we also expect information and communication, the financial and insurance, and also the real estate sectors to continue to perform quite strongly. The leading indicators point to a pickup in growth in the third quarter of 2024 and reflecting the resilience of key services sectors and robust performance in agriculture and improved exports. So for the third quarter of this year, we are projecting a growth of 5.2%, and this is consistent with the overall growth of 5.1% that we are projecting for the year as a whole. Turning to monetary developments, the growth in money supply moderated in August 2024, partly reflecting reduced credit to private sector and valuation effects of the appreciation of the exchange rate of the Kenyan shilling against the major currencies. The slowdown in growth of credit to private sector across most sectors reflects the impact of the exchange rate appreciation on foreign exchange loans, but also the lagged effects of previous tightening of monetary policy. Nevertheless, credit extended by SACCOs has been resilient, partly reflecting comparably lower lending interest rates compared to the banks. Short-term interest rates eased slightly in August and have been easing for the last 2 months, while the average lending rates have stabilized, partly reflecting the impact of the reduction in the CBR rate. Growth in broad money moderated in August 2024, again partly due to the slowdown in private sector credit growth. The slowdown in M3 growth reflects, in addition to the slowdown in private sector credit, there is the reduction in other items net, and also the reduced positive contribution of net foreign assets of the banking system, partly reflecting the base effects relating to the G2G oil imports and the impact of the exchange rate appreciation. So the slowdown from 5.7 in July to 3.3 is somewhat exaggerated by the fact of the appreciation of the exchange rate, because there are some deposits that are denominated in dollars, and also the base effect of deposits related to the G2G oil arrangement. So moderation in the growth in broad money supply, as I've indicated, reflects the exchange rate valuation. And again, you can see that if we adjust for the exchange rate valuation, then the growth of broad money M3 would have increased by 6.2% through August, as compared to 3.3. The dotted line is the growth of M2, and basically it's M3 excluding any foreign exchange denominated deposits. But still, you can see that there is a pickup in M2 in August compared to July. But nonetheless, the broad direction is of M3 decelerating, again, which would be expected because of the tightening of monetary policy, and therefore the reduction in credit to the private sector. In regard to the credit to the private sector, there was a decline in August. Again, we see the 12-month expansion in credit to the private sector having decelerated from 3.7 in July to 1.3%. If we adjust for the exchange rate effects, then the credit to the private sector would have grown by 4.3% rather than 1.3%. But still, this is a deceleration in credit to the private sector, even after taking into account the impact of the of the appreciation of the exchange rate on loans that were denominated in foreign currency. Again, this is a representation of the 12-month growth in credit to the private sector by currency. The middle line is the overall credit to the private sector, and the slowdown to 1.3. And then we have disaggregated that credit to the private sector into credit that is only in local currency, and credit that is denominated in foreign currency. And as you can see, the credit to the private sector in local currency loans was at 5.2%, and the fact that foreign currency loans declined by minus 10.6% is what has contributed to the slowdown in overall credit expansion to 1.3%. Again, this is a depiction of credit to the private sector from the banks. You can see at the end of August, the 1.3 overall. But we also wanted to draw attention to the growth in credit by SACCOs, which has actually increased between July and August from 9.3% in the case of SACCOs to 11%. The next table, this is a table on showing the commercial banks' weighted average lending rates per loan category and also maturities. This is something that we publish on a monthly basis, and it will show you which banks are charging the lowest interest rates and which banks are charging the highest interest rates. And I think this is good for the consumers to be able to make an informed decision about where to and from which banks to get their loans from. In terms of the new monetary policy implementation framework, this is based on the corridor, and this has now, we have been able to align the interbank rate to the CBR, which was the intention. And on the left-hand side, you can see that there has been a convergence of the interbank rate towards the CBR, which was the intention. But also on the right-hand side, you can see that the interbank spreads have narrowed significantly. And also the variability has reduced quite significantly. Turning to the balance of payments, the overall balance of payments deficit narrowed in the 12 months to August 2024 compared to a similar period of 2023, reflecting improved goods exports, strong remittance inflows, and recovery in imports of goods, and also a strong performance in the financial account. The overall balance of payments is projected to be a surplus of US $554 million in 2024, which should result in a reserves build-up of $1.9 billion after taking into account the IMF disbursements for the 7th and the 8th review. The current account deficit was 3.8% of GDP in the 12 months to August of 2024, from 3.7% in the 12 months to August of last year. And this reflects a recovery in imports and lower service receipts, even as exports continued to improve and remittances remain strong. The current account deficit is expected to remain stable in the medium term. It is projected at 4% of GDP in 2024 and 2025, driven by improved exports, resilient remittances, even as imports recover against a background of a stable exchange rate. The main external sector risks relate to the escalation of the conflict in the Middle East and potential volatility in international oil prices. So these are the details of the balance of payments. Just to take you maybe to the second to last column of 2024, with a current account deficit of about 4.8 billion, which is financed by the financial account of about $5 billion, and the result is an overall surplus of $554 million, which if you then combine with the inflows from the IMF, the very last row, the disbursements of $1.367 billion from the IMF, results in build-up of reserves at the central bank of $1.920 billion. So as I said, the current account is expected to, and has narrowed from an average of 5.1 in 21-22. Last year it narrowed to 4% of GDP, and we expect this level to be sustained over the medium term. In terms of goods exports, these increased by 14.4% in the first 8 months of 2024 compared to a similar period in 2023. And this is a significant improvement compared to last year, where the exports actually contracted in 2023 compared to the previous year of 2022. So we see a significant improvement in exports this year. And specifically, we are seeing improvement in exports of vegetables, which in the first 8 months have increased by 30%. We also see an increase in fruits exports. Tea exports have also increased quite significantly by at least 7.8%, and cut flowers are also increasing at 4%. Another category of improvement is miscellaneous manufactured articles, and this includes things like footwear and clothing, and we do see an increase in export by 19% in the first 8 months. And finally, re-exports have increased quite significantly and these have doubled actually, they've increased by 105%. And so overall, we see an increase in total exports of 14.4% the first 8 months. Turning to imports of importation of goods, we do see that these have increased for the first 8 months. These have increased by 7.3% compared to the first 8 months of 2023. Again, this is quite a significant turnaround. Last year, in 2023, there was actually a reduction in imports from about $19.3 billion to about $17.2 billion, which was roughly an 11% decline. So this the turnaround and growth of 7.3 is quite significant. And unlike last year, when there was an increase in the importation of food and live animals, the reverse is now the opposite. That is to say that food and live animals, the importation has declined quite substantially, and you can see that on the very last column. And but we now see an increase in the imports of intermediate goods and also of capital goods. For example, if you look at the crude materials, we see them increasing by 21.4%. Chemicals also are increasing quite significantly by 8.4%, and that is only because of the reduction in manufactured fertilizer, which has been to a certain extent substituted by the raw by the crude fertilizer. You can see crude fertilizer is actually increasing quite significantly at 22.1%. So generally, we are seeing an increase in imports of intermediate goods, but also of capital goods, and specifically the machinery and transport equipment, which is increasing quite significantly. With regard to remittances, these have also been very strong this year, increasing by 16.4% in the first 8 months of 2024 compared to 2023. By way of comparison, all of last year, remittances only increased by 4%. So the 16.4% is a significant improvement over last year. For the year as a whole, we are projecting remittances to increase by 16% and basically to slow down to 7% in 2025, partly reflecting the very, very good performance in 2024. Again, for this increase in remittances reflects higher inflows from virtually all sources, from all the markets. The United States is increasing by 9.7%. Of notable increase is the United Arab Emirates, where we have a doubling of remittances with a percent increase of 102.4%. And so, as I said earlier, for the first 8 months, you can see there that the increase in remittances is 16.4%. And for the 12 months to August, that increase is 12.7%. But we do expect the remittances to increase by 16% for the whole of this year. On tourist arrivals, these have improved by 21% in the 21 months to August 2024 compared to a similar period in 2023. And for the first 8 months of this year, these arrivals have continued to be very strong at 19.3%, and we do expect this sector to continue to perform well. In terms of the usable reserves of the central bank, we've seen a significant improvement in the gross usable reserves of the central bank. We started off the year at 6.5 billion, and we have now been able to build our reserves to $8.2 billion, which is equivalent to about 4.24 months of import cover. The Kenyan shilling has strengthened by about 17.7% in 2024, and this has been supported by foreign exchange inflows from financial services, that is offshore banks and remittances, but also export receipts from the agricultural sector. So the left-hand panel compares our appreciation, the 17.7 strengthening of our currency vis-a-vis global currencies. And then on the right is a comparison with the African countries. And of course, you are aware of the major reforms that Ethiopia has been implementing in terms of liberalizing its foreign exchange market. And there you can see that the birr has depreciated by actually more than 100%. So the Kenyan shilling is actually one of the best performing currencies, not only within Africa, but also globally. Again, this is a depiction of where we have been. We had a fairly depreciated exchange rate coming to the end of the last year. And we started the year at an exchange rate of around 160, 161 shillings to the dollar. And we have been able to bring that down all the way to 129. And you can see basically from around, for the early August that the rate has remained relatively stable at around 129, 129.2. And given the strong inflow of foreign exchange, this has also permitted us and facilitated us to increase the level of our reserves by some purchases in the foreign exchange market. Turning to fiscal developments, the ongoing implementation of the 2024-2025 supplementary budget is expected to lower the fiscal deficit to 4.3% of GDP from 5.2% of GDP in fiscal year 2023-2024. The total revenues in the supplementary budget for fiscal year 2024-25 are projected at roughly 3.1 trillion, which is equivalent to about 16.9% of GDP, and this is down from the previous estimate of revenues of 3.3 trillion, which was what was in the initial budget that was submitted to Parliament. Total expenditures are projected at 3.88 trillion, which is equivalent to 21.5% of GDP. And again, this was a reduction from the budget that was submitted to Parliament, which had total expenditures of 3.99 trillion shillings. That was then equivalent to 22.1% of GDP. The fiscal deficit, including grants, is projected at 768.6 billion, equivalent to 4.3% of GDP. And this is compared with the initial approved budget of 597 billion shillings, which was equivalent to 3.3% of GDP. With this deficit, net domestic financing has been reduced from 595 billion, or equivalent to 3.7% of GDP. So the domestic financing in the fiscal year 2023-24, in the fiscal year that just ended, was 595.6 billion. Now that is proposed to be reduced to 413 billion in this current financial year 24-25, and this should go a long way to ease pressure on further pressure on interest rates. So fiscal policy over the medium term seeks to implement fiscal consolidation to slow down growth in the public debt by broadening the revenue base and also containing growth of non-priority expenditures, while at the same time enhancing social safety nets. The fiscal consolidation in the medium term should reduce debt vulnerabilities while moving the present value of debt to GDP ratio towards the target anchor of 55%. So the ongoing fiscal consolidation in the medium term, again, should, as I said, should reduce debt vulnerabilities by reducing the fiscal deficit to 4.3 for this financial year 24-25. But over the medium term, the intention is to continue to narrow the fiscal deficit and increase the primary surplus, so that by 2028-2029, the overall fiscal deficit will only be 2.8%, and by that time we should have moved towards our target, our anchor target of the net present value of debt to GDP of 55%. On the banking sector, the total capital adequacy ratio stood at 19.1% in August 2024, the same as it was in June of 2024, and remained above the statutory limit of 14.5%. In terms of the liquidity ratio, as of August, the ratio was 54.3%, and a slight increase from 53.5% in June. And again, this is compared to the statutory limit of 20%. The ratio of gross non-performing loans to gross loans stood at 16.7% in August 2024, compared to 16.3% in June. And banks have continued to make adequate provisions for the NPLs. Finally, this is just to give you some data related to banking sector performance up to August of 2024. So thank you very much.
Thank you. And that was the Governor of the Central Bank of Kenya, who's also the Chair of the Monetary Policy Committee, Dr. Kamau Thugge. And as usual, we take questions. Just a reminder, if you want to send any questions, send them through Slido, slido.com. The hashtag is hashtag MPC1024. We shall begin with Charles Mwaneki from the Nation Media Group. So Charles asks, has the CBK been buying dollars from the market given the $837 million rise in forex reserves over the last 5 weeks? Kefa Moirore, also from the Nation Media Group, asking, the 7th review of the IMF program remains pending. What are the remaining hurdles to clear this disbursement, and when can we expect this review to close? Final one from this batch, from Herald Allo from the Africa Report, asking, how confident are you that the current stable currency and US rate cuts will encourage significant inflows to Kenya and solve asset problems?
Let me start with Mr. Mwaneki on the issue of the CBK buying dollars. As I've explained in the past, our exchange rate policy is to allow the exchange rate to be determined by the forces of supply and demand. We do intervene when we see basically to moderate excessive fluctuations in the exchange rate. And it is true that we've had a significant increase in foreign exchange, both from banks but also remittances. So in order to moderate the fluctuations and volatility in the exchange rate, we have indeed been buying foreign exchange, and that is part of our role, and that's part of our business. And of course, the same can be said when the exchange rate, when there is need to intervene on the other side, when the exchange rate starts to weaken, then we would be able to intervene even on that side. But it's intervening to reduce volatility, not to affect the overall direction of the exchange rate that would reflect the fundamentals of the economy. So for this particular time, we do have quite a significant amount of dollars coming in, including also from tea as well. And so yes, we have been intervening somewhat in the foreign exchange market to build our reserves. And We do now believe that we have been able to strengthen our external buffers significantly. In the past, we have been able to build the international reserves of the central bank, largely from either loans from the IMF, loans from the World Bank, etc., etc. But we are now building reserves not related to loans, but related to the excess foreign exchange that is actually coming into the economy. Kefa has asked a question about the 7th review and what are the remaining hurdles to clear this disbursement. So I think we have been having discussions with the IMF. The discussions now are really to combine the 7th review and the 8th review. We've made a lot of progress, significant progress. We are in the final stages of an agreement. The fiscal framework has been agreed. The fiscal deficit that I mentioned earlier of 4.3% of GDP has been agreed between the Treasury and the IMF. And so we have in our projections for the reserve build-up for the year as a whole, the one I mentioned, the $1.9 billion of accumulation, has assumed a disbursement from the IMF before the end of December. So I would say that discussions are progressing well, and we do expect that disbursements will be made before the end of the calendar year. Mr. Allo has asked how confident we are that the current stable currency and the US rate cuts will encourage significant inflows to Kenya and solve asset problems. I think suddenly the US has already cut their policy rate by 50 basis points last time. We had cut ours by 25 basis points last time. We have now to going ahead to reduce the policy rate by a further 75 basis points. It's also expected that the US is likely to make 2 further cuts perhaps in November and also in December. So our 75 basis points, I think, is in line with that, with what has already happened in the US, that US has cut by 50 basis points, and is now expected to reduce their policy rate by 25 basis points in November and a further 25 basis points in December. I think the question perhaps would be whether the reduction in the policy rate will have any impact on our exchange rate, and the answer is no. As I've indicated, part of the strengthening of the exchange rate is actually coming from exports, agricultural exports. It's also coming from remittances, and there is a part that is obviously coming for to invest in the securities because of the high interest rates that we have. But I do believe that given that we have a stable exchange rate, that there is scope to reduce interest rates further without and still for them to be attractive enough for foreigners to still to be able to invest in our local securities. So I don't see that this will have any negative impact on the incentives for investors to come and invest in securities.
All right, the second batch of questions, we begin with George Obulutsa from Reuters News. George is asking whether there's an update on the progress made in Kenya getting the $1.5 billion loan from the United Arab Emirates. And I believe the second part of the question where he's asking for an update on the IMF's review, that's just been answered by the governor. Stella Swake from Standard Investment Bank asks, government security rates remain high, especially in primary auctions. How does the CBK plan to lower these rates amid elevated borrowing needs? And finally, from this batch, David Herbling from Bloomberg News, who's asking, does the Central Bank of Kenya have any plans to set term limits for bank chief executive officers?
I think on the question from George Obulutsa, I think on the issue of the IMF review, I think I've already provided an answer to that. I think on the issue of the UAE, discussions have been held with Treasury, between Treasury and the UAE. It's at the moment, I think we are finalizing with the issues to do with the IMF. I know there is little scope for additional commercial financing, but these are discussions that the Treasury will continue to have with them, broadly speaking, with other external creditors to see how we can not only finance the budget deficit, but also reduce Treasury recourse to domestic borrowing. And that leads to the second question by Stella Swake on how does the CBK plan to lower these interest rates amid elevated borrowing needs. I think that is part of the solution is the reducing government recourse to domestic borrowing. As I said already, the budget, the supplementary budget that has been submitted to Parliament this year has already reduced domestic borrowing to 413 billion. Last year it was close to 600 billion. So we are reducing recourse by the Treasury to domestic borrowing by almost 200 billion. So I do believe that that reduction should have a positive impact on reducing domestic the interest rates on government securities. Mr. Hubling asked about setting term limits for bank CEOs. I think that issue has not been, we have not discussed that issue.
All right, thank you. The last set of questions, we begin with Brian Goge from the Standard newspaper. Brian is asking for clarity about the percentage of Kenya's foreign exchange reserves that is currently encumbered and what is the nature of those encumbrances. Back to Kefa Moirore from the Nation Media Group, the last question for today, which is that banks have bet on a sharper rate cut to nudge interest rates on facilities lower. Do you expect the borrowing costs and non-performing loans to ease just as quickly after the jumbo cuts?
I think on Brian's question, to clarify the percentage of Kenya's foreign exchange reserves which is encumbered, I think it's actually very small. I imagine it's I think of our total reserves now of about 8.2 billion. I don't think more than $250 million is, or 600. Yeah, so I'm being told it's about 600 600 is what is encumbered, but the figure I'm giving you is what as the gross usable reserve. So for you to get to the gross position, you'd have to add that $600 million to what we have given you as the gross usable reserves. But the gross usable reserves are at 8.1, and by the end of the calendar year, we expect to reach about $8.6 billion. Yes, I think Kefa, on the of course the whole idea really of this sharp reduction in the CBR rate is to encourage the banks to lower their lending rates so that we can also reduce the NPLs and also encourage borrowing by the private sector from the banks. You've seen a huge deceleration in credit to the private sector, the 1.3%. This is fairly low, and we think that this is likely to have a negative impact on economic performance, and that's why we have decided on a fairly large reduction in the CBR. Of course, we also, that reduction is also informed by the fact that inflation is well below the midpoint of our target range, and also we have had a significant increase in foreign exchange, and therefore we have stabilized our exchange rate. And in addition to that, that even with this reduction in the CBR, we still feel that will not result in any significant outflows of foreign exchange, and therefore there's no reason for the banks not to adjust down their lending rates so as to incentivize borrowers to take on more loans.
Thank you very much. And that brings us to the end of our post-MPC press briefing. As usual, these materials will all be available to you, especially what you've just seen with regard to the presentation, as well as the CBK MPC surveys. Those will all be posted on the usual place, that is our website, as well as our social media. You can engage with them in detail there. But as the governor said, it's expected that the MPC will meet again in December. So until then, do have yourselves a good afternoon and a good time.